Hello everyone, welcome to Bytes Special. I'm Nikhil, and in today's special Bytes video, I'll be discussing with you what is the root cause of the Silicon Valley Bank fallout and how it's going to impact the lenders, Indian lenders especially. So before we go to the topic, let's start with the basics. Uh, the whole bubble burst was caused by the central bankers, where they kept interest rates at lowest levels in the last couple of years to encourage the economic growth. But this also caused the inflation to rise very sharply, and it went out of the control. And none of the central banks in the Western countries have anticipated that inflation would come in double digits. So, in order to fight against the inflation, the central banks have taken the interest rates uh, at high back to decade highs, especially at in US, where the last 1.5 year, the US Fed has taken interest rates from 0.25% to 4.5%, and at a very rapid pace. So this caused the liquidity in the market dried up completely, and lack of liquidity has caused many of the lenders, or let's say even many of the part of the financial segment to suffer. In last year, we have seen in UK where the pension fund had issues with the redemption pressures, and they had to sell out most of their the government bonds in order to meet the redemption pressures. In the end, the UK government stepped in and the cooled the markets. And in the SVB case as well, the US government intervened and assured that depositors would get their money back. And none of these central bankers now can afford any the larger size of a bubble burst in the financial system, where they can't take the rates lower, and with taking the rates lower, they'll have inflation higher. So they're completely out of any financial support right now to bail out any of the big guys in the market. So even with the SVB, what the US government wanted to do is, so they want to support this SVB so that there is no such bigger impact on the financial system. But however, today if you see the US regional banks, most of these banks, the share prices fell. They fell by most by 50% to 80%. That shows that the market participants are still worried and concerned about the SVB thing, how it's going to play out, and till what extent the whole market will have what kind of impact it will have on the market. Basically, SVB, this bank, the Silicon Valley Bank, is to have the many of the startups is to park their money at SVB so that they can use the money whenever they want to. But due to their asset liability mismatch, they had to sell around 21 billion worth of T-bills in the past 1 week. And all these T-bills were invested 1 2 years ago at levels of average level of 1.5%, average yield of 1.5%. Due to rapid increase in the rate hikes in US, the currently the treasuries are trading at close to 4%. This led to MTM losses on their books, and also they had to sell off 21 billion worth of treasuries at a loss of close to $2 billion. So the same thing what happened in one of the UK pension funds. So this asset liability mismatch, it's one of the biggest issue where the banks, the lenders face during the interest rate hike cycle, would lead if weak lenders to go for a insolvency as well. So coming to Indian lenders, especially the lenders with a weak capital adequacy, and they don't have a great asset quality, will have a very tough time to raise money in this kind of tight conditions. Either they have to come out with a very higher yields in order to attract money, but the such higher yields they cannot afford to run their businesses as well. So this whole tightening of the liquidity will have a huge impact on those lenders who are basically the last 1 2 years, where they were surviving on the cash flow from the VCs and the private equity guys. So once these VCs and private equity guys stop to fund these lenders who the lenders who are giving loans to the risky borrowers, This will have an impact on their day-to-day operations and would force them to file for even insolvencies as well. And also, even the capital, it will weak the capital flows. And in India, we're also facing the rising deficit. This will have a whole impact on the INR. INR also. INR could depreciate further. If you're investing in bonds, we would suggest you to check out the PSU bonds, which have a very great credibility, and also they're offering close to 8% right now with a maturity of 1 2 years. So look at the shorter end of the curve, where the whole curve is inverted otherwise globally. The shorter end of the curve is offering better rates than the longer end. And in this kind of a market, investing into at the longer end of the curve with the lower rate, and you're also taking a lot of credit risk if you want to invest at the longer end. So we would suggest you to look at the shorter end of the curve with 1 to 2 years of a duration, and the PSU bonds, and especially they can also offer you the good liquidity if you want to exit in the secondary market as well. You can check out the great PSU bond offers and on our Quick Invest app, which is available on both the App Store and Play Store as well. So do check out our curated list of bonds. These are all curated which are perfectly fit for this kind of a market. And thank you for listening in. Do subscribe to our YouTube channel if you're not done so already. Thank you.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.